How are you?
Hey, Dad.
Okay, great timing on that phone.
I told him.
Hey, guys.
I told Nestor. I don't have Noah's number.
Welcome, Paul. We are live. Welcome to the show.
I told Nestor.
Paul is ordering a bumble at the moment. I'm just going to mute him. He's back.
Listen, my dad called me. What do you want me to do?
Hello, everyone. Just let you know, welcome to the show. As always, all our beautiful followers, you are second fiddle to Paul's dad, of course, but you're now on first burner. Welcome to the show. Paul, we are stoked today. We are super fired up. I mean, I don't mean to be all showy and like game show like, but Jesus, I'm sitting here dancing behind the scenes to this lit music. We have so many followers already, and we love you guys. We appreciate you. Paul is in Mexico. I am in snowy Ohio. I will be joining him in 2 days from now. I got to get up at 4 in the morning, Paul, to get on that flight down to Manzanillo. We will be broadcasting next week live from Paul's gorgeous mansion on the cliffs of the Pacific. And Trader Mo is in the house sitting right next to Paul. Paul, how are you? Describe your beautiful New Year's Eve day to us.
It's wonderful. I'm going to be going to bed early tonight, and I will wake up tomorrow on a brand new day to watch football and hopefully watch the Ohio State Buckeyes get smashed by Clemson, I'm hoping.
And the Buckeyes will win tomorrow, Paul. So, Nick, yeah, he is actually in Mexico. So, folks, Paul, this is a humble brag here, guys. Like, I follow a lot of YouTube channels, I'm sure, like you do. And Paul, we see these guys, and they're just like they're giving you stock tips from their dorm, in a dorm room. And sure enough, this is real, guys. This is Paul. This is his one of two mansions down there, and they're incredible. Paul, I think this is my 6th trip down there. And it's absolutely incredible, and I can't wait to spend a week with you, and we'll do so many episodes for our viewers. Wouldn't you say, Paul?
Yeah, and John Fessing just gave a thumbs down and said he's going to thumbs down until it takes back the OSU comment. Not only will I not take it back, I'm going to go even further. No, I'm just
kidding, Paul, please, Paul, let's not get into that. Okay, folks, listen, today, Paul, what are your plans for today's show? We have a bunch of stocks from patrons. The Patreon is going absurd. We turned that on 2 months ago.
Why don't we also take some questions from people on the year in general? And guys, don't ask me to predict where the market's going to go next year, but maybe more fundamental questions about the market or certain things as opposed to, hey, Paul, where's the market going to end up? I have no idea where the market's going to end up, nor do I care. Why are you laughing?
Oh, people are commenting on my shirt. This is my favorite shirt, guys. And
it's a great shirt.
I know it's absurd, but this is the kind of who I am, Paul. A little out there, a little lively. So, yeah, Christopher, we welcome you in. Alex, Trader Mo, of course. David, our homie. Paul, we have a follower now that has a name in a foreign language. So I'm sorry I can't get that one, but we welcome Milan. I see you there. Gary, I see you. Everyone. Carlos, I see you there. Thanks for everyone for stopping in. As always, much like Paul's little belly, is we want you to tickle that thumbs up button. Paul loves tickling, especially in his sex life. So just make sure you're tickling him, and don't pull a Rudy Giuliani there, Paul, and expose your but make sure you're tickling that thumbs up. We love you. Guys, listen, we have a bunch of stocks in store for you today. These are off our Patreon request line, If you're in love with what we're doing here and you want more, if you want access to us, access to the people who think like us, you can join Patreon and get access to Paul, right? Paul, talk about the Patreon.
The Patreon's great. We're getting double-digit members every day. People are really engaging in the chats. It's a great place to get like-minded people. I keep going back and forth on, do we end the Patreon when the website comes out? Do we not end it? I think we're going to keep it going, but the lowest level will go away. It's currently $8. The lowest level will go away because everyone who's a Patreon member will get free access to the website for the 8 pillars and all the financial data. So the lowest level will go away. The second the website's ready, I will eliminate the lowest level. Now, granted, everybody's in the lowest level now will stay there, but you will not be able to buy new membership at the lowest level. The lowest level then becomes $15, and you'll still get full access. But that's why you need to sign up now, because if you have a desire to support us now, I'm going to reward you by getting you access to full financial data and the 8 pillars in the future for free, as long as you're a Patreon member.
My wife is on the chat. My son Gio will be joining us, and John has an interesting. Christopher has an interesting question, Paul. Before we get into our first stock, at heart, you're a real estate guy. What do you think about the real estate market?
It's funny. I'm not at heart a real estate guy. I'm at heart an investment guy. I actually started with stocks when I was in my teen years, but real estate, since it takes up so much time, it becomes like a career for you. Real estate market's very expensive. I've made offers in the last year. I post every week or two on LinkedIn about whoever finds me a deal north of $5 million, an apartment deal anywhere in the country. If I buy it, I'll buy you a $100,000 sports car. I've made several offers this year, come close on a couple, but it's just a very tough market right now. But interest rates are so low that people are fine making 9, 10, 11%. But also don't forget, just like in stocks, their assumptions are always, everything's based on what your assumptions are. Garbage in, garbage out. And if you can show assumptions that make sense, then you can justify a deal. And if it works, great. If it doesn't, well.
Paul, I have a quick surprise for all of our followers. You and I, they see us and, they keep seeing us as these two YouTubers, but we are people as well. I think, one time, Paul, I asked you, your meaning of happiness. And people really like when we kind of show who we are. So in response to that, Paul, I want to show you a couple things real quick. This person is who this for our Everything Money crowd.
Hank,
this is my 7-year-old Hank.
Hi.
And here's the camera here, babe. And he's got a portfolio. He bought H&R Block yesterday, Paul, and he's very happy. He's got about $1,000 saved up as a 7-year-old. Say hi to everybody.
Hi.
And one more, Paul. You know this cat. Now, he's been on the channel before. I can't pick him up because he's so big. This is my 10-year-old Gio.
Hi.
And Gio is creeping out $3,500 in his portfolio. So he's very, and a huge Browns fan. And he watches Paul all the time. So anyway, guys, shut the door on the way out. I love you. But Paul, those are my kids. You know them very well. And just to our followers, that's who they are. So love you guys.
I love them.
Okay. Paul, shall we get into it? We have our first off the request line, one of our OG followers, Dom G. I love you, Dom. Is Dom C? I know, Dom, I love you. Let's look at Comcast, Paul. Comcast, the ticker is CMCSA. Comcast stock. Let's look at this company.
All right, you see my screen?
Go ahead, Paul. Sorry about that. Go ahead, brother.
All right, so Comcast, wow, big surge. Geez, OP, look at that.
What's the market cap on this puppy?
So $238 billion, call it $240 billion right here. So that's a big number. PE, not so bad. It's an X still, but it's at 23 after such a big run up. Let's see the last year how it's gone. All right, so it hit a low of 32. Okay, so it's up about 60% since the low, 65%. Profit margin's a little light, so 2X's so far. So 8% profit margin, but a really high gross profit. And 23 PE with a dividend of 1.8%. So right now their dividend is roughly $4 billion, let's call it. Does that make sense? Does that sound right? That sounds right.
Yep.
Okay.
Pillar number 3, Paul, is revenue growth, folks. Just in general, if you're new to us and you're a new subscriber, we're going to go through. I didn't even preface this, Paul. We're going to go through our 8 pillars, looking at a company, and you can follow along with us, and I will certainly recap. But pillar number 1 is PE ratio. We want that less than 20. And pillar number 2 is profit margin. We want that above 10%. Pillar number 3 is revenue growth. We want to see the revenue growing, Paul. Go ahead.
All right, so the revenue growth was 74.5 up to 109. So definite check there. With cable companies, it's important to know Are they making acquisitions? So we'll look at that number later, but this is pretty solid revenue growth if it's all organic.
Paul, how's the profit growth? Was that a check on revenue?
Yes, definite check on revenue, definite check on profit. Wow. 8.2 billion up to 13 billion.
How about pillar number 5, which is number of shares outstanding, Paul? We want this number going down.
It has been going down for the last 10 years, so it's a check mark, 4.97 down to 4.5.
Very good. So we're doing great. First 2 X's and 3 checks. How about pillar number 6, which is current assets greater than current liabilities?
Current assets are 27 billion. Current liabilities are 29.5. So there's an X there. Now let's look at past years and see if this is a recurring theme. 27, 27, 24, 25. It seems like it's a recurring theme where they have more current liabilities than current assets. That seems to be pretty consistent for them. Oh, well, okay. That's fine. Cash flow, the big mamma jamma. So remember, guys, this is the most common question we get. So I'm going to start spending some more time explaining this on every video we do. The free cash flow and earnings, net income, should be pretty similar over long periods of time. They should be pretty similar. But earnings have a lot of adjustments made to them as opposed to way less for cash flow. Cash flow is cash in, cash out. Free cash flow is your operating cash flow. That's the cash you generate from the business itself, less your capital expenditures. Now, capital expenditures are your investments back in your property, plant, and equipment. There are 2 types of capital expenditures, maintenance and growth capital expenditures. On these financial statements, they talk about both of them combined. In a 10K, sometimes they'll split them out. The maintenance capital expenditures are the capital expenditures they're making to maintain their business. Like existing plants, existing property, plant, and equipment, they're just putting the money in there to keep it going. Growth capital expenditures are things like building new plants to go create more revenue or create a new product line or something like that. So on a company like Comcast, I'm probably going to be mostly maintenance. So I just deduct all of it. But operating cash flow, less your capital expenditures, gives you your free cash flow. And your free cash flow is used to pay dividends, buy back stock, make acquisitions, and do other things like that that can help grow the business. And to me, I care more about that number than the earnings number. So let's go back.
Sure, guys, this is free cash flow growth. Go ahead, Paul.
So it went from 9.5 billion to 13.3 billion. So definitely a check mark there.
Okay, Paul, give me the numbers one more time. Go ahead. 9.5.
9.5, 13.3, 12.6, 10.1, and 9.
Okay, divided by 5 years is 10.9. So folks, let's slow down. I know this gets everybody. So we took the free cash flow from the last 5 years. We added it up and got the average to get the average free cash flow growth, Paul. Cash flow. So now we have 10.9 as their cash flow, free cash flow, and we're going to multiply that to get to a desired market cap that we want to pay for the company. And once we have that, we'll compare to what the real market cap is right now and see if it's over or under price. Paul, go ahead.
So the most common question we get is, how do I choose the number we multiply by? Basically, you want to pick the same PE that you're looking at. So a fast-growing company, you should pay a higher multiple of free cash flow, because if they can grow their earnings and profit faster, you're willing to pay more for it, right? If a company's making $1 a year for 5 years, you're going to pay a very different number than if it's going to make $1, then $2, then $3, then $4, then $5 in year 5, correct? Because you're going to want to pay way more money for that. That's the whole idea here. There's other factors involved too. Is it a very established company? With a more secure company, you might be okay, even if it's not growing fast, you might be okay paying a higher multiple. This is part of the art of investing. You have to sit there and determine what you think the right return is for you for that company. If there's a lot of debt, you want to have a low free cash flow. It's all these factors that get involved. Now, for a company like Comcast, they're already very large, right? So the growth is going to be hard. And I saw the financials. If you look at their financials here, they had a big jump in revenue. They did make a $34 billion acquisition. So that definitely affected them here. Let's see their last 12 months and how that's gone. The revenue is down in the last 12 months. Their profit is also down in the last 12 months. So I don't know if that's because of COVID or what the reason is. It's something you have to sit there and factor in there. Let's look at their cash flow in the last year, their cash flow was 13.3. In the last 12 months, it has been 13.9. So slightly higher. I think 15 times, I think for a company this large, I think 15 or 18 times is probably a reasonable number. Again, that is my assessment of it. I'm not saying it's the right number. I'm not telling you that it's the right number for you. If you sit there and say, listen, I think Comcast is a great company. I'm good with them. They're phenomenal. I'm okay with it, blah, 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 blah. Then maybe pay a higher multiple. I'm going to sit there. Seth, do times 18 and let me know what that number is.
I did times 16. So, guys, we're taking the free cash flow and multiplying it times 16 to get us the market cap we want to pay at the multiple of 6. Yeah, 170. Yeah. So, so it's
not far off. It's not far off.
Mm-hmm.
Now, I want to make note, guys. During the pandemic, it's at an all-time high. So, what would it take for the company to be worth $176 billion? Let's see. So 176 divided by 238 times $52. The company stock has to be about $38 for me to be excited. So guess what, guys? It was there all day. In the last 5 years, it's been there. So I look at this saying, okay, this is pretty good. Like, this is a company that just needs a little bit of a pullback. In fact, Mo, where is this company based out of? Pennsylvania? Why does it have 5 tickers for its, that's usually reserved for European stocks. But either way, I like this company sub 40 in a sense of from a value for what I think you can get. Now, let's go actually put it into my trusty Excel sheet, which I want to share with you guys. So I got to stop this share.
Guys, make sure, guys, we're talking about Comcast, the company Comcast. The market cap is 240. Paul has a target market cap of around 196 or less. So he's going to pull up his Excel sheet and show you the numbers. As always, make sure you're tickling that like button. Paul, go ahead. You got your charts up?
I do. So let's do this. So right here, guys, the annual revenue growth has been 8.2% and annual income growth has been 6.1. Now, keep in mind, I am discounting this revenue growth by a lot. In fact, probably more than this. I should probably do a bigger discount because it's all been natural. But look at this. The current price is 52. I think it's worth between $38 and $48 a share. Now, me as a value investor, I want a premium. This is the 10% return we do historically. I want 15% return. I'm going to pay sub 40. If you look right there, 30 to $40. That's my price. But if you want the normal market value, I think $38 to $48 is a reasonable number for Comcast. It's not far off. It pays you a 2% dividend. And that dividend, by the way, is very supported. It's only $4 billion a year. Their cash flow is double-digit billions. They're in the 10 to 12 billion a year in free cash flow. So they can easily afford that dividend.
I'm here, Paul. I'm here. I'm just taking in everything you're saying. All right, guys. So it's current no on Comcast. They have to drop a little bit. Their PE is not good.
Off, though. Seth, hang on a second. It's not far off. Like, this is definitely a company where I'm telling people, if you like the company, do more research, figure out how their revenue streams are going to go. Because cable is hard because of the fact that of all the streaming. The biggest issue with cable is streaming, right? That's the biggest issue is streaming, and that's going to be an issue they have to deal with right now. They have 59 million U.S. households that they service and businesses. You got to figure out how their streaming is going to be affected, how streaming will affect their business long run.
Owen says, if you intend on holding stock for a very long time, should you pay a little higher as well? That's interesting, Paul.
I think you pay a premium based on the company, and I don't think it matters short-term or long-term. I think what matters is the company itself. Do you think the company garners a higher premium for the qualitative aspects of the business and even quantitative? If it's a fast-growing company, pay a premium. If it's like Apple, I don't think Apple should sell for 13 to 15 times revenue with an established brand, or Google.
Okay. I see you there, Yellow Eric. Paul, he wanted to look at, he's looking at a company, Pult Homes. I'll write it down, Eric. Thanks. We got a ton more to go through, guys. That was just the first one. Let me see if there's any other questions. Guys, make sure you're putting in there. Oh, hello from Lithuania. See, I love these, Paul. I was just going to say, guys, make sure you are typing where you're from. We love Paul. I'm just shocked that people all over the world are following us. It's incredible, guys, and we really appreciate it. Paul, would you like to jump onto a different company? We have more requests, and I have one queued up. How about Hanes Brands? You want to look at Hanes Brands, HBI?
Well, remember, we've already looked at Hanes. Remember, I've owned Hanes Brands. I thought it was worth about $15 a share. I've since sold it. What's it at right now?
$14.50.
Yeah, I sold it at like $13.50 or $14. I like Hanes Brand. They're a very strong brand. They're in 9 out of 10 households in some fashion. They provide. I do have puts on them. Currently. They provide all the clothing, I think, for like Ralph Lauren and Polo and those guys. They're a very, very established brand worldwide, selling for a low multiple. I think I bought them at like $9 or $10 a share, and I sold them at $13 or $14 a share because I think they're worth about $15 a share. I think they're selling for right about where they're worth.
Oh, Llewellyn. Okay, I see Llewellyn saying, yeah. So, guys, El Pippi gave us that off the Patreon request line. So, did we do that before, Paul? We did Hanes?
Yeah, we've talked about Hanes in the past. I don't know if there's a separate video for it, but we've talked about Hanes in the past several times on the live stream because I own them and I currently have puts on them.
Okay, guys, we will. I'll mark that down, El Pippi. We will look at Hanes. Paul and I will do a video on it in Mexico to sort of recoup what's going on. Paul, how about another amazing one? PayPal. I'm sure you're in love with PayPal like me. Do you want to look at PayPal?
Yeah, and PayPal's super expensive. I know that. Like but I like their financials.
Okay. Do you have to switch to Y charts?
Oh yeah, I have to switch the thing. Hang on a second.
Guys, it's incredible seeing where you're all from. We really appreciate it. Make sure you're tickling that thumbs up. We really appreciate that. And if this is your first time here, just say hello. A lot of the folks who are commenting have been OG followers of us for a long time. So if Paul and I are not answering the questions, I assure you there's tons of knowledge in that comment section. So make sure you stay active. Hector from Jamaica, amazing. Oh my gosh, wow, Still Sticks is in the Bahamas, Paul. Good Lord. Okay, Paul, let's look at PayPal, my friend.
Okay, so PayPal here, $270 billion company, so worth more than Comcast. PE, look at this PE, that's a big X, 87. And I told you, I looked at PayPal before, very expensive stock, but I think it's a good one to look at. Great profit margin, 18.7%, great gross margin of 57%. So that's all looking good.
So pillar number 1, PE is an X, and pillar number 2, profit margin. That's really nice, Paul. Pillar number 3 is revenue growth over the past 5 years.
Of definite revenue growth, $9.25 billion to $17.8 billion. So chickadee check right there. Net income doubled, $1.23 billion to $2.5 billion roughly.
Oh, that was profit?
Yep. So we have a check on revenue and profit, and we have a check on shares. 1.22 billion down to 1.174 billion. So consistently buying back shares.
Nice, folks. We want those shares going down so they're not. Explain that one more time, Paul, for some new viewers. Why do we want the shares going down?
So let's say hypothetically you have a company has 10 shares and you own one of them. You own 10% of the company. Now let's say they issue 2 more shares. You still own your 1 share, but now there's 12 shares outstanding. You now own 8.33% of the company. So you still own your 1 share, but you own less of the company. Flip side is, let's say they go from 10 shares to 8 shares. You still own 1 share of 8 now, you own 12.5%. So when they're decreasing the shares, they're giving you a larger percentage of the company as time goes on by doing nothing. Now, does that mean you only want companies that are decreasing shares? No, none of these pillars in and of themselves are the good or bad. It's more of what are they doing when they issue shares? Are they making good acquisitions? Are they issuing shares at high prices to make good acquisitions? That's what matters. But overall, I want to see pretty steady share numbers or decreasing, especially on bigger companies that have a lot of excess cash flow.
So, Paul, was PayPal issuing more shares or buying them back?
No, they're buying shares back. Like, it's a check mark there.
Great. Pillar number 6 is current assets greater than current liabilities.
This is going to be a massive check mark, I believe. 48.7, and they have 35.25 in current. But look at this. They have $47 billion in total liabilities. So they have enough cash on hand to pay off all their liabilities.
Great. Okay, Paul. That's pillar number 6 for current assets. Great. Free cash flow growth, folks. This is cash from operations minus capital expenditures. Big words, Paul.
I know. Now look at the cool thing here. Their capital expenditures have stayed pretty consistent the last 5 years, but their operating cash flow has really increased. So this is definitely a check mark here in terms of free cash flow growth. Now, you ready with your calculator, Seth?
Yeah, I'm ready. Go ahead, Paul.
1.8, 2.5, 1.9, 4.6.
Wow.
3.8.
divided by 5 years, 2.9, Paul.
All right. So, and they're growing fast, guys. And look at the last 12 months. In the last 12 months, they've generated $5 billion in free cash flow.
So, guys, again, Paul, real quick before you get this is PayPal, guys, and they have 2.9. Is that $1 billion in free cash flow? The average over 5 years. Keep going, Paul.
But the most recent year was 5. I imagine during the COVID shutdown, they've probably skyrocketed in terms of their revenue and profit and things like that. Guys, I'm actually going to go higher, I think, than 20 times free cash flow on this one, because they're growing at a nice clip. So let me see here. PayPal, load. Now, it's still a big drop, though. But I do think this, okay, so wait a second. Let's do this. 75, 75, 75, 15%. Yeah, I think it's still, so let's multiply it by 25. I think 25 times free cash flow is reasonable here. That's
a market cap of 73 billion, Paul, and they're currently 270 billion.
Yes, which sounds about right, because they have an 87 PE. So even at 20 or 25 times PE, you still need the company to be, this company is still going to be 50, 60 bucks.
Guys, I'll tell you, let me step back here, guys. One of the most rewarding parts about hosting the show, being friends with Paul for these last few years now, and just spending a lot of time with you guys, is just on a simple company like that. I really just enjoy the idea, the process that Paul goes through to come up with the numbers. Like, again, if you were like me, where you only ever looked at stocks because of their price, we just did an analysis of PayPal, including all of their financials. And as someone who's very intelligent in this, can show you all of this sort of makes sense, what the PE versus the market cap works. And Paul, I just love it. I mean, it's just great. And now it's starting to make a lot of sense to me. It does take time, folks. I mean, we've been on this show for 2 years, and I still call Paul with questions all the time. But that process, Paul, talk about, just step back a minute, like what we just did with PayPal, and talk about that process.
So the process is very much driven by the analytics and the financials. And I look at it saying, a business, what you should pay for a company is the present value of all of its future cash flow. The question is, what is their future cash flow going to be? You have to make assumptions. You have to look at the potential in the industry, the sector, the company. There's a lot of qualitative aspects that will explain what the future quantitative results could be. We don't know what those are going to be. If we knew, we'd know exactly what to pay for a company. If I could tell you the exact cash flow a company will have for the next 10 years, and I'd say, okay, but I want to make 15% return. It's a quick calculation. This is what you have to pay. But we don't know those things. But what I'm trying to do is figure out, based on what I see, buying a portfolio of stocks that hit my criteria. These 8 pillars were created by me, like naturally. And then we were like, what do we do here? I didn't ever keep track of 8 things. I just always looked at these things. And one day Seth just said to me, well, how many is that? I'm like, well, it's 8 things. Like, okay, so that's what it was. I'm looking at everything saying these 8 pillars provide a story for me from a 500-foot view. Like even right now, somebody made a comment, Square is a challenger to PayPal. I disagree. PayPal is more than just a payment processor. They're essentially a bank. They let you hold money in there, transfer money. Things like Square, from what I understand, is merely credit cards. Square is awesome, don't get me wrong, but they're not the full aspect that PayPal is. PayPal has got Venmo. I love Venmo. I pay 3 or 4 of the people who do work for me with Venmo on a weekly basis. I love it. It's the best. It's great. So PayPal is becoming immersed in our lifestyle, and that's what I like about it.
Paul, what do you think about Benjamin, our OG follower? What do you think about this comment? He 40x multiple on this. What do you think? I mean, PayPal is a monster, bro.
But that's the part you have to figure out. The question is, are you willing to pay 40 times a company's current free cash flow to get the future stream? I don't know. That is your decision to make. I do everything from an analytical standpoint, saying what is the right number. At $50 a share or $60 a share, that would be how much free cash flow? Let me see. It would be a lot lower, but I just think 40 is a lot for any company their size. For $240 billion market cap, for $20 billion in revenue, essentially, 40 times free cash flow is a hard number. Does that mean I'm right? No, absolutely not. It's just, I look at it saying my job as an investor is to make decisions on a portfolio of stocks. And I think there's 10,000 stocks out there. I want to make reasonable assumptions on all of them and pick the 30 or 40 that are selling for below that number. That is my goal.
Paul,
but if your goal is,
go ahead. I'm sorry. I cut you right off. Go ahead.
If your goal is to own an awesome company for a long period of time and you don't care about the next 10 years, 40 may be the right number.
Paul, a patron of ours, Nick, of course, why don't we ever divide the market cap by free cash flow to find the true free cash flow as the eighth pillar? Do you know what he's talking about?
Yeah. So basically, Nick, great question. But Nick, our goal is to figure out where the company should be, not what it is right now. When we have the website up and my Excel sheet is in the website, it will tell you the current price to free cash flow, absolutely, on the previous 12 months. But I'm trying to sit there and say, what do I want it? Where do I want the company's value to be for me to be excited about it? That's why we do it the other way.
Travis asked, Paul, how often should we go back and reanalyze a stock? You know, I asked you this last night, Paul. How often should we redo a video on like an AT&T or an Alibaba or Altria or, you know, Palantir? What are your thoughts on this?
Every quarter, new financials come out. Every month, new news comes out. Every week, news comes out. You just pick. That's why you have to pick a good 20, 30, or 40 stocks that you can really follow and make sure you're always paying attention to. There is no set number on how often you should look at it. Sometimes it's once a year. Sometimes it's once a quarter. Always just keep an eye and set your news alerts to tell you when something big happens, just so you know stories can change over a long period of time. If all of a sudden Microsoft's doing awesome and all of a sudden we find out tomorrow that the SEC investigated them because they were defrauding investors, that's going to change the entire picture of the company. Yeah. You'll want to know that. Is that very likely with Microsoft? No, but these are the things you have to sit there and pay attention to. In terms of reanalyzing, one of the great things that the website will do for you is it'll allow you to put all your stocks in at once. At some point, it's not going to be the first iteration of the website. You put all your stocks in at once, and it'll pretend you own your own company of those stocks. It'll tell you how the entire portfolio's 8 pillars. Are you check marks? Are you not check marks? Where are they hurting, et cetera, and why? So that'll be a good way for you to keep up to date on those stocks.
Malesh, I don't know about the charging. Don, maybe you can help us with the Patreon charges. I don't think you're going to get double dipped on that. Let's see. We got.
I think I know that one. I think Patreon just charges you on the 1 month of anniversary of every single company.
Yeah. Guten Tag, greetings from Germany. Dejan is asking about H&R Block. And funny, Paul, someone else said H&R Block totally sucks. Guys, we found the opposite. Paul, did our H&R Block video come out, Don? I can't remember. But regardless, guys, we analyzed H&R Block in a separate video. And it was surprisingly awesome, Paul. Their market cap is almost half of what you think it should be. And so both of my children bought H&R Block yesterday, Paul. They're very excited. So
I like H&R Block. I think they have a good brand. You know, somebody was saying, well, people can do their taxes for free. Well, you can also ride the bus to work, but we still buy cars. I mean, I think H&R Block, they also guarantee the return. If there's any mistakes, they swallow it. I think there's a lot of benefit to that. And they do very well internationally based on their free cash flow and how they were affected last year because of COVID, this year because of COVID. I felt comfortable starting a position on them, and I sold a lot of puts on them.
Yeah, Mage, if you look back we've talked about Tesla just unwaveringly the entire year, and so you can look back at our other videos and check them out. And guys, as always, make sure you are tickling that thumbs up. Give Paul's little belly a tickle there. He really enjoys that. He's a pampered child, little baby, and he enjoys his likes. Paul, should we look at another company, Paul? What do you think?
Yeah. So let me answer Mira El Pipi's question first. If you have 20, there's been stories, there's been data done. If you have 20 stocks that are diversified in multiple sectors, that's supposed to eliminate normal market risk. So it basically has you tracking. They say 20. I like 30 or 40 just because of the other things I do. Options and things like that. I want to have a more diversified portfolio.
Paul, why don't we look at off the request line? We're going to look at Captain Car gave us a Starbucks. Paul, I love Starbucks. You don't drink coffee, but I love this.
I don't, but I do like Starbucks a lot.
And I'd love to see their financials, Paul. Let's look at Starbucks.
So we don't look at the stock price very often, but again, all-time highs. And it was as low as, what was it as low as this year? $56 a share. That's pretty low. It was basically half of what it is today. So $125 billion market cap. PE, look at that thing. Now, wow. This PE of 138, it's the last 12 months. I'm quite sure in the last 12 months, their revenue and profit were hit significantly. So I'm not as worried about that right now. I'm not worried about this PE being a big X. It is a big X, but I'm not as worried about it because I'm sure that the shutdown drastically affected their business. So profit margin last quarter was 6.3%, so an X there as well.
Oh boy.
Keep in mind, dividend yield 1.7% on 125 billion is around $2 billion roughly. Is that right? Probably. Revenue growth.
Pillar number 3, revenue growth, Paul.
19 billion to 21.5. And keep in mind, this 21.5 ends in September. So this is including COVID shutdown. So this is still a check mark with the COVID shutdown. So I like that a lot.
How about pillar number 4, Paul, is profit growth?
2.8 down to 928. So it's an X. But again, that doesn't bother me so much because of the fact that COVID was a big chunk of this. Does that make sense?
Yep. How about the shares for Starbucks? Are they going up or down?
Big check, 1.47 down to 1.173.
It's pretty good.
Yeah.
How about current assets over current liabilities is pillar number 6, Paul?
7.8 billion versus 7.35. So a check mark there. Barely, but it is a check mark.
Okay. And then free cash flow growth, Paul. Pillar number 7.
Okay. So 5 years ago, it was 3.2. And this year, it was 0.1.
0.1?
Yeah, remember, they had a big drop in their operating. It's a big drop. So what I want to do, Seth, is here, I'm going to eliminate last year completely. I'm not even going to look at last year. So I want everybody, when they sit there and say I'm super strict, this is where I sit there and say, well, wait a second. COVID's not going to happen forever, and it's not going to occur very often. The last time we had a big shutdown was the Spanish flu in 1918, 100 years ago. I'm not going to invest based on the 1 in 100 year outcome affecting the entire economy. So I'm going to eliminate all of last year. So let's include the 3.2, Seth. Let's do 2.7. Let's do 10.
Wow.
And let's do 3.2. And then let's do 2.4.
We're finding free cash flow for Starbucks divided by 5 still, Paul?
Yep.
Free cash flow per year average is 4.3 billion.
Okay, 4.3 billion. Now, Starbucks is a great brand. I'm okay paying 20 times free cash flow for this. What you got?
That is 86, Paul.
Okay, so 86. They're currently at 125. Not bad. I mean, it's again, you might sit there and say, "Oh my," but we're at all-time highs, guy, in a very expensive market. I think to myself, this is all this has to do is drop from 106 to 70, and I'm good, and I'm ready to start buying. Oh, sorry. Let's go look at the year to date, guys. It was at $70 just in June and July. You know what I mean? So I'm looking at going, okay, this is in striking distance. You should be looking at this. Mo, have you looked up puts on Starbucks? Are they garbage? Yeah, so the puts on Starbucks are garbage because it's such a popular stock, but this is a company well within striking distance, and it's a great brand. This is something that I don't think is going away ever. They have 32,000 stores worldwide, and guess what? The world is still developing. They're going to have a lot of growth potential overseas. This is going to be a very big growth potential still as time goes on. And I shouldn't say I don't think it's going to happen. I don't think it's going to happen where you're going to be sitting there getting Starbucks from a drone from Amazon. You're not going to be getting coffee that way. Starbucks still has that great brand, and people love it, and they kill for it. So talk about brand. I mean, if I ask you right now, coffee, if I just said to you, I'm going to say coffee, you tell me what you think of. How many people would say Starbucks?
Yeah, I mean, I'm just always amazed. You go through any airport, and there's just 40 people in line. You go through your random Starbucks down the road, and there's the line here by my house, Paul, just wraps around the building. I mean, they're always selling that coffee. And I'm a coffee snob, and I still love it. Paul, do you want to pull up momentum on Starbucks potentially? Maybe pull that up. Do you have time?
Yes, do I have time? Let's see here.
Guys, make sure you guys are smashing that thumbs up. We're super, super appreciative. Paul and I just did a video that kind of wrapped 2020 for us, and just we have incredible thankfulness for you guys all over the world. I wish I could get to know more of you more, and the patrons, I'm dying to get to know more of you on a personal level. We will be going live next week to Patreons only. So patrons, if you're there and you have questions, we will give you your own 90 minute to 2 hour, however long we go, a session next week with Paul, myself, and trader mode to answer all of your questions that don't get answered today. So Paul, go ahead, pull up the momentum for Starbucks. We're still analyzing.
Can you share my screen real quick? I'm going to show something.
Go ahead.
This is my Excel sheet where I run my models. This is where the model is flawed. Look what price they just gave for Starbucks. 23 to 30 bucks. Guys, remember, this is also factoring in the last year, which was absolute shit, in which I sat there and said, guys, we're not even going to look at the last year. So this is where models are sometimes flawed when you have these black swan events that occur that affect the numbers. I sat there and said, sub 70, I'm a buyer of Starbucks. It's telling me to buy between 23 and 30. This is where the human approach of investing has to occur, where I'm not even looking at this going, I don't care what that says. I'm not buying it at 30 bucks. By the way, I'm buying it all day at $30. I'm betting a house at 30 bucks.
Yeah, the price is currently 107.
Yeah, but that's not the point. The point I'm making is my value I came up with was around $70 a share.
Yeah.
That's the point I'm making. So momentum, let's go back to momentum here. Okay, so remember the blue line is the 200-day moving average. The orange line is a 300-day. When the 200-day goes above the 300-day, that is a bullish sign. You want to buy. When it goes below, you want to sell. So in the last few years, if you bought right here at 55 and sold right here at 83, you made a lot of money. It's getting very close to going back above it, guys. The 200-day and the 300-day are about ready to converge again right over here. At a big number, that's a bullish sign though. So again, when we ran this back test for 20 years on a 75 stocks, this buying and selling based on this alone, you beat the market by about 1.2%. You have to be very, very strict on yourself and go, I'm going to do this every single time, no matter what.
Paul, let's look at, do you want to say anything else before we move on to another company?
Are there any generic questions about, not generic, but are there any questions about anything we're talking about here?
We have some Patreon joiners, which we're appreciative of. Owen said here in the UK, Starbucks is open 2 stores every day for 30 years. Yeah, it's incredible. Yeah, we love it, guys. It's great. Paul, are you drinking wine? What are you drinking? You're drinking, Paul, you still drink like 6 Cokes a day?
Probably more.
Yeah.
Coke Zero. This is Coke Zero. I have a lot of them down here. I have 2 at every meal.
Paul, let's look at, this is off the request line. David, of course, our lovely follower who's been with us from the get-go, wants to look at Smith & Wesson brands. Paul, you're not into guns. I'm not either. But do you want to look at Smith & Wesson? Ticker symbol is...
I mean...
What, Paul? SWBI.
My problem with Smith & Wesson's is the liberals out there who want to pick and choose which parts of the Constitution they care about are going to make it a very tough stock for a long period of time. What?
You're a liberal, Paul, you said? All right, let's go. What is the market cap?
I said the liberals
what is the market cap for...
what is pick and choose which constitutional amendments they care about.
I'm just going to talk right over you, Paul. Let's get to the market cap.
Like a typical liberal. All right, $1 billion market cap. PE of 26, surprised by that, actually. I'm actually quite surprised by that. 21% profit margin, though, so big check there.
It's pretty good. How about revenue growth over the past 5 years, Paul?
Okay, revenue growth has been there. Oh, no, it has not been there. 723 down to 678. Wow. Big drop. Ooh, and they lost money last year. Okay, what is going on here?
How about profit growth? Did you just do it?
Hang on a second. I just did that. Oh, but wow. Their sales surged in the downturn. Oh, wow. Look at that. Yeah, their sales really surged in the downturn because people were scared. All right, profit growth, that's an X. 94 million down to 61 million.
How about shares outstanding, Paul?
Up barely, 54.76 to 54.98, so that's an X as well.
Oh, boy. Current assets, pillar number 6 is current assets over current liabilities.
215 in current assets. Guess what, guys? 125 in current liabilities, 174 in total liabilities. So they have about $50 million more. You buy the company today, you're basically paying $50 million less for the company because of the change there.
That's good. How about free cash flow growth, Paul? Pillar number 7.
So free cash flow growth, 138 versus 80. So definitely an X there.
Oh, boy. They're going down.
So 138, 80, 87, 42, and 23.
Wow. Divided by 5 is 50.
Guys, I'm paying very little for this company, 12 times free cash flow, because I feel like the future of guns is going to be very difficult. This is a great brand, but I just think there's going to be a lot more regulations on guns and a lot more haters on guns. I personally don't even want to own this stock, not because of any moral issues, just because I just don't trust the government and what they're going to do with it. So I look at it as going, unless there's some great growth potential there, that's not a surge. I mean, like, yeah, the last year has been a big surge with the shutdown. I mean, their free cash flow jumped to $240 million. So they're essentially selling for 4 times free cash flow right now. But how sustainable is that free cash flow? I don't know. I just don't know how sustainable this income growth is, because it's up 50% in the last year. I just don't know how sustainable that is, guys.
Paul, Hector asks, have you ever thought about applying a weighted average to each metric? What is he saying?
Yeah, we talked about that. We did talk about doing that. The only problem is that's qualitative. It's just, remember, my goal for the 8 pillars isn't to tell me. We talk about doing the weighted, going like, okay, what's more important? Because there are ones that are more important than others. The free cash flow growth, revenue growth, profit growth, and PE are way more important to me than even profit margin. But that's the whole point. Once you use these more and more and start looking at more and more stocks, you're going to get a feel for what matters to you more. I guarantee if you ask 100 investors about these 8 pillars, they would probably disagree on several of these, saying, I wouldn't even look at that. I don't even look at that. It's just all your style. One of the big things about investing is picking the style that works for you. Over time, after reading a lot, looking at a lot of companies, these 8 things just happen to stick out to me that I always looked at, that I always wanted to keep track of. That's what worked for me. Now, the 8 pillars, go ahead.
Oh, Daniel has a great question. I keep cutting. I see, guys, it's my job to kind of cut in and not leave dead silence. So sometimes I cut Paul off. But Daniel always has incredible questions. Should we make an ETF based on all the stocks that meet the 4 pillars and update it? That's pretty interesting, Paul. What do you think?
So, Daniel, the funny part is when we back tested the 8 pillars, it did very, very well. When we back tested it 20 years, it significantly beat the market by several percentage points. That is something we could definitely consider. And in fact, we still talked about having the patrons get involved in some sort of purchasing of stock for my account and me somewhat sharing in the profit at some point. There's a lot of things we can do. The 8 pillars, only buying the ones that are all check marks would be awesome and fun to do. And I do believe that they would do a lot better than than the market over time. So that's something that we definitely have to consider.
Paul, your chess coach, yeah, my mug, Paul, you've seen this mug, right? You love this mug.
Old fart.
my father got this mug, God rest his soul. My father got this mug in 1988, and now I'm using it. Paul, you and I will be 40 next year. Well, tomorrow year. And so
yes.
That big party we were planning might have to put on hold. Oh, there it is. The Mexican burritos. I can taste them now, Paul. Handmade, hand-rolled Mexican burritos by the senoritas in the kitchen. I love it. All right, guys. Should we keep going?
Yeah. What else do you want to talk about?
Well, I have tons of other stocks, Paul. Do you want to look? One that catches my mind. We've looked at Expedia. Masawi asked for Expedia. We've looked at that. Can we look at Smuckers?
Oh, local company, SJM, right?
Yes, SJM.
They're where are they? Orville, Ohio.
Yeah, so this is about.
That's where Don lives. Don lives in Orville, Ohio.
Okay, yeah, this is about 30 minutes from my house, and obviously a staple to our community. Let's look at it, Paul. What is the market cap for Smuckers? They make jellies, of course.
$13 billion company.
Wow.
PE of 15, so check mark there.
Nice.
Profit margin of 11.35%, so check mark there.
So far, so good. How about revenue growth? Pillar number 3.
Well, hang on a second. Hang on a second, Seth. 3% dividend. So they're already spending about $400 million a year on dividends, which is awesome. So they're giving out a good dividend as well. Okay,
Don's all fired up about Don. What do they do besides jelly? I don't even know. Don's all fired up about this. He's got his jelly shaken and he's ready to go. His milkshake brings the boys to the yards. Paul, pillar number 3 is revenue growth over the past 5 years. Let's do it, baby.
7.81 to 7.80. So barely an X, but it is an X nonetheless. This is a very flat company.
Okay, how about profit growth? Pillar number 4.
688 million to 779. So check mark there.
Great.
Now, one thing I want to look at here is whenever I see revenue growth not increasing, but profit increasing, I want to look at the operating income. And the operating income is about steady. The operating income is all the income of the business just for operating the business. And I look at that saying it's pretty steady here, which is consistent with the revenue. So that's something to consider. Shares outstanding, 119 million versus 113. So check mark there.
Very nice, folks. We want those shares going down so they're not diluting. So Smuckers shares they're buying them back, right, Paul? That's great news.
They are. So far we have a check mark on everything except for revenue growth, correct?
Yep, that's correct. Great memory. Pillar number 6 is current assets over current liabilities, Paul.
2 billion in current assets, 2.7 in current liabilities. But let's see, it seems like they tend to run, wait a second. Just 2 years ago they had, it seems like they tend to run lower on current assets and current liabilities. So if historically it hasn't done that, it hasn't had more current assets, I'm not as worried about it. I worry about like if all of a sudden it's a big flip. If all of a sudden goes from, we can cover our nuts, all of a sudden we can't. Free cash flow.
Sorry, Paul, I was reading some comments about, whether you don't go through a lot of peanut butter, do you? You don't eat like Jiffy or Skippy, do you?
I love smooth peanut butter on white bread, but I just can't eat it because I'd probably eat 10 sandwiches a day with milk.
Yeah, I love that too. That's good stuff. I put honey on mine. I have those bees, folks. So I have the bees out back. I get the honey from the bees. I put it on the jelly and I put it on the peanut butter. It's incredible. All right, Paul, let's go. We did current assets. They're underwater a bit, huh?
Yep, correct. Now we're going to free cash flow growth.
Free cash flow growth over the past 5 years. Go ahead, Paul.
1.25 billion down to 1 billion. So that's an X there.
Uh-oh.
So 1.25, 1, and then 0.8, and then 0.9, and then 0.85.
Sorry, Paul. Divided by 5 is it's basically 1 billion.
Okay, so they're currently selling for 13 times free cash flow. I mean, that doesn't seem bad to me. I look at it going, okay, I mean.
All right, hold on a second. Let me slow you down, Paul, real quick. So, folks, here's what we did. We got the free cash flow, which is decreasing over the years. But we got the free cash flow, and then we multiplied that times what, Paul?
So here I was looking at it the way that they suggested. It's 13. I immediately remembered that it was a $13 billion company.
Yes.
So 13 billion divided by 1 is 13 times free cash flow.
Okay.
For a company like this,
So sorry, Paul. Let me just real quick. So our pillar number 8.
Our biggest complaint on the things is that you interrupt me a lot. So then you keep interrupting me a lot.
That is true. So I'll just do it one more time. So again, once we get that free cash flow, we multiply it times a number to find the market cap to see if Smuckers is over or undervalued. We usually multiply by 20. In this case, Paul, we multiply by 13 because their market cap is $13 billion, and they have a 3% dividend. So give us your final thoughts on Smuckers. Double thumbs up?
I like it. I think to myself,
come on.
Did you look at puts on Smuckers? SJM? Yeah, Smuckers is great. I think, because I look at the brand going, food's not going away. They've got to, everybody in this, I wonder what percentage of this country knows what Smuckers is. Everybody knows. I remember first time I heard Smuckers was in Ohio, I was shocked. I'm like, Smuckers is in Ohio? We have that big of a company in this small town in Ohio? That's awesome. So I'm a big fan. Right now, my price is, I'd buy it today. I'd wait to do more research on it, but I'd buy it today. That's one of the things we have to go and do more research on. But maybe SJM is, let me put it in my Excel sheet and see what it comes out at.
So just to recap, guys, we're looking at Smuckers, a $13 billion market cap. They have a 3% dividend. Their PE ratio and profit margin are good. Their revenue is going down, but their profit is growing. They're buying back shares. They do not have, their current assets over liabilities is not as good, and their free cash flow is not growing. However, their price to free cash flow for their market cap is only at 13, Paul. That's very nice. Go ahead. You got it pulled up there?
Yeah, I think that it's probably worth about where it's at right now, because the growth is the issue. They've had a lot of growth in the last. If you look at their revenue, so their revenue is flat over 5 years, but look this year, the last 12 months it's up a little bit. So we need to. You got zero fish, Dad? My dad went fishing today. He got 0, like no bites or anything. Sweet. I could have done the same thing. You just gave me $300.
So if you guys ever go down to Mexico, you can go fishing out in the ocean. They pull in. Darnell last year, Paul was pulling in these massive fish. It's incredible.
All right. So anyhow, I think Smuckers is one of those companies that if you look at them, you're not going to get a lot of growth out of them. You're going to get a good dividend. They're generating a lot of cash flow. They're going to buy back more shares. I think this is something that I'm going to be looking at further in detail on Smuckers. Yeah. Well, my dad likes Smuckers because he's biased though, because don't you do business with Smuckers? We used to. Oh, really? Didn't you used to have like a sender there for the for EHCS? Wasn't that Smuckers? Oh, I'm thinking Cheers. Gotcha. Okay, so I like Smuckers, guys. I think you should look further into it, do more research about it.
Paul, folks are really asking about fast food chains. It seems like a lot of people are jumping on boards here. Salty Box Gaming. Some other people are asking about Domino's.
One thing, Ben Rourke said, SJM has 18 years of consecutive dividend growth. That's solid. And they're spending about $400 million in dividends, and they make over $1 billion in free cash flow. They can afford that dividend. But they just bought Folgers.
Oh, really? Okay.
Yeah, FU Star. Oh, 2008 they bought Folgers? Oh, okay. Well, my dad said they just bought it.
Instant Tortoise. We have looked at Kroger before. Peter, we have looked at
Campbells. Let's look at Campbell's.
Okay, we have also, Peter, we've also looked at Tattooed Chef. Just check our videos, and we've done that, right, Paul?
I think Tattooed Chef is like a joke or something like that. We'll have to look at it. But Campbell's was requested by a patron. So let's look at Campbell's here. Guys, everybody hit that like button because I really need the likes for my ego to start the year off right.
That's true. That's true, Paul. You do need that.
Okay, Campbell's, $14.5 billion company. Look at this PE, 8.22. Guys, this is Campbell's effing soup. Everyone in the world has had Campbell's effing soup a billion times, and you were sick, your mom fed you Campbell's soup, whatever it was, and it's selling for 8.2 times earnings in the last 12 months. Let's look further, but that seems, off the bat, I'm like, that's so cheap to me. They have 13% bottom line profit margin. That's awesome.
So that's pillar number 2, guys. We want our profit margin above 10%, so 13 is obviously great. Pillar number 3 is revenue growth, Paul, over the past 5 years.
And they have a 3% dividend, which is paying out $425 million a year.
Great. Keep going.
So revenue growth, I don't imagine it's going to be good. And it's 7.96 to 8.69, but there was a big drop here. So I'm sure they sold something. They probably sold a company or a division right here. So you have to look into that. But it is a check mark still. Their net income has tripled from 563 to 1.6. Now here's the issue. How did they go from 211 to 1.6? That's a red flag for me. Now I'm going to go to their operating income. Their operating income, maybe we might want to change our pillar to operating income growth. I don't know. We'll see. But either way, it is down there. So they're probably just big write-offs these last 2 years. So I'm okay with that. But it is still a check mark on profit growth.
How about pillar number 5, which is number of shares outstanding?
Check mark there, barely. 309 million versus 302. Doesn't look like they're too aggressive with that, but that could change if they keep generating more and more cash flow.
Christopher says, "I'll take your white charts log." And Christopher, you're in luck, because as a patron, you will get access to, right, Paul? I mean, tell folks as they're watching what they're going to get with the app and the website.
Everything I use white charts for here, you will get in the Everything Money 8pillarstocks.com website. If you're a Patreon member now, everybody gets it. Sign up now because it will be going higher. You get to reserve your price today. For the time being, it's going to go, the minimum level is going to go to $15 from $8. So if you have any desire to have all of this and the 8-Pillar website, go sign up now, pay your $8 a month. It'll be available in the next 3 to 4 months. So you're overpaying, but you're still getting access to all the Discord, get to be around like-minded people. You're crazy for not signing up for the Patreon today.
Jerome, I see you there. We've at AT&T is one of our more famous videos. Just subscribe and search our videos, and you'll find the AT&T videos. Just a couple months ago, we did a full in-depth analysis. You can see all of it. Paul, we are on Campbell's Soup. We have all check marks through 5 pillars. And did we do current assets over liabilities?
We're doing that now. 2.5 basically versus 2.9. So X there. But it seems like the food companies all have this issue. They all have less current assets than current liabilities, it seems. It just seems like a very consistent thing amongst food companies. I don't know why.
Funky Town beat the 8 pillars. Great question. Some
What was the
of
question?
they said, can we write down the 8 pillars for a newbie? That's a great question. We keep watching. You're not supposed to just know this right off the top of your head. And something we're gonna do. Paul is doing a video. Paul is doing a video on each pillar, and it's coming out very soon. But some of our friends in the chats will certainly help you with that, with the 8 pillars. Go ahead, Paul.
So free cash flow. It went from 1.15 to 1.1. So it's technically an X. So 1.15, 1.1, 1.95. 0.95. So let's start from the beginning, Seth. 1.15, 1.1, 0.95, 0.9, and 1.
Divided by 5, the free cash flow growth, the free cash flow average is just basically 1.02.
All right, guys, this company is selling for, if you want to multiply this by 15, it's in the money. That's what this is saying right here. It's in the money for buying at 15 times free cash flow. Look at this. Back in freaking, in the last 5 years, the company's been as low as freaking $32 a share. So right now, it's selling for what I think it should be selling for, about 15 times free cash flow. I'm not, and guess what? Their dividend is $450 million. I think they're easily supporting that dividend. With a great brand like Campbell's, do more research on all their debt. But I'm not opposed to that. I think to myself, this is definitely one that if I'm researching, I'm like, okay, I need to research this further. I think I said that yesterday when somebody mentioned Campbell's to me. I said it was very interesting. So go figure it out. Go. I think it's quite awesome. I think it's good potential and it's a great brand. It's selling at a cheap price with a good dividend.
Paul, they market the guys like me, bearded jerks who are watching football, and they've done this new thing where the Campbell's, they say it eats like a meal. But Nick is correct. Remember Mama McNabb, Donovan McNabb's mom in the marketing, like maybe 10, 12. That was incredible. It really humbled what's that?
What was that? Is that what Mo just said? She goes, chunky soup.
That's what I'm talking about. That was just an incredible way to bring a big sports figure down to somebody like us. Yeah, we all got a mom that gives us soup. It's incredible. So, David, I see you there.
I like Campbell's soup. I'll eat it out of I don't care. I love the soup. I think it's great. Their chunky soup, it's great.
David, we've looked at NEO multiple times, and we're enormous non-fans of NEO. Just look at our past videos, and Paul talks about his stance on that. Oil sector, Paul, great dividend. Paul, we don't look at oil too much, do we?
No, and the reason being, it's oil companies in general. It just the commodities prices change so much and change their profitability so quickly. It's just hard for me to get a good gauge on that.
Listen, Mary El Pippi, who has an incredible, Paul, let me put him up here. This has an incredible following, Paul. You and I both watched some of his videos this week. If you're subscribed to us, go ahead and click over to him. Now, obviously, you have to be Spanish speaking, Paul, which I'm not. So, Mira, I didn't get a lot of your videos. My apologies. I'm working on my Espanol, but he's got a great following, so check him out. But Paul, he's asked a few times for UPS. I'm interested too. Do you love UPS like me?
I like FedEx more, but let's look at UPS anyhow. I like UPS too. Oh my God, look at this. Look at this chart this year.
Oh my.
Look at this thing. Oh my God, it was $87, and now it's almost doubled in price. All right, you ready, Peanut?
Well, tell me this, Paul. Right off the bat, we're definitely not buying low here, are we?
No, but remember, buying low to me is about buying relative low to value, right? It's not about buying a low. It's about buying. Let's put it this way: if there's a wallet with $10 in it, and you can buy it for $20, that's not good. If there's a wallet with $100 in it, you can buy it for $50. That's awesome. Even though 50 is greater than 20, you're buying more for less. You're buying more relative to value. Does that make sense?
Yes, of course.
Buying a Ferrari for $100,000 versus buying a Ford Focus for $100, same price, totally different value. That's what I'm trying to teach. Is try to find the Ferrari at a reasonable price.
Okay, UPS. What is the market cap for UPS?
$145 billion with a very monstrous 31 PE right now.
Well, not too monstrous, Paul. I mean, we want it to be 20, but we've seen some that are hundreds.
Yeah, that's the whole point of the current market. Like back in the day, if you read books from back in the day, like 30 was considered astronomical, nosebleed, like you're crazy. 9.2% profit margin, so X on both, and a 2.4% dividend yield, which is roughly call it $4 billion in dividends they're going to pay per year.
Okay, pillar number 3, guys, is revenue growth over the past 5 years, Paul.
58.4 to 75, big check mark there.
Nice. How about profit growth?
Though, X. Wow. So that's weird. Their revenue's skyrocketed, but their profit is the same, is lower actually. Let's go see their operating income. Yeah, their operating income is very stagnant. So that's a concern of mine, guys. How does a company increase their revenue by 30% and their profit has stayed the same?
Benjamin might as well be a co-host of our show. With Amazon in their own trucks getting out there, are you nervous about delivery companies? I think they should be nervous.
That's definitely something to consider. You have to consider that because of that exact reason. Amazon accounts for 50% of all online orders, and they're starting to get their own trucks out there and planes and all that stuff. So it's something to definitely consider there.
So pillar number 5, Paul, is shares outstanding. You want this going down?
Check mark, 901 to 864.
Okay, how about the current assets over liabilities for UPS?
Okay, let's look at that. Current assets are so call it $20 billion. Current liabilities are 15.46. So check mark there.
Great. How about the granddaddy of them all, free cash flow growth, Paul? Let's look at it.
Okay, this is an X.
Uh-oh.
Yeah, it went from 5 billion down to 2.3 billion.
What about the middle ones, Paul?
So 5, 2.3, 3.5, negative 3.8, and then 6.5.
Wow, negative.
Yeah.
Divided by 5 is 2.7, Paul.
Okay, 2.7 for UPS. I do agree with the risks on Amazon and Walmart. I mean, I'm thinking mid double digits, maybe 15. Do 15 and see. Multiply that by 15, you have about a $40 billion market cap, right?
Yeah. So all these pillars lead to what Paul has found to be what he wants this company to have, a $40 billion market cap, and its market cap is $140 billion, Paul.
It needs to fall by a big chunk. It needs to fall by a huge chunk. And to me, instead of getting discouraged about it, I'd sit there and say, okay, moving on, find a different company. Like a lot of people sit there and go, damn, come on, it's not I can't buy the stock. There are 10,000 stocks in the US, guys. Go find a different company. Go figure out a different one to buy. There's others out there. Let's just move on from it. UPS is nowhere close to the level we want it to be at.
The comments are so funny. Some of our patrons are just joining. It's really funny. And our new patron, Nishant, said, it needs $100 million haircut, which, Paul, I cut my own hair, Paul, which I thought was looking pretty fly this week. Although some days I just give up. I'm like, screw it. I can't see the back. I'm going for it. So,
you should get Hanger Gino to help you.
Oh, yeah, that'd be great. Yeah. All right, guys. Paul, we've done so much in this live stream. Comcast, PayPal, Starbucks, Smith & Wesson, Smuckers, Campbell's Soup, and UPS. Are you tired? How are you feeling?
I think we should take the next 20 minutes and just answer questions about, listen, the year was different. It was quite the different year. And the next year, I know people want to get, look at our business, for example, Seth. Our business, we took hits in some areas. I think we were able to make money in every single business except for our fantasy football one, obviously. I just look at it saying, but we're so optimistic about the future. We're so big on what the future could hold. And remember, guys, a good business is good whether the economy is good or bad. A bad business gets exposed in a bad economy. That's why I always want to preach to people who do well in stocks now. Like, everybody makes money when stocks are good. Good investors make money or lose a lot less when stocks are bad. We're trying to teach you how to lose less money or make money even when stocks are bad. Some of these ideas I have, guys, if you go look at how they performed in history, they had up years during years when the market was down 30% and they were up. you just have to be very patient and realize that value is across all spectrums. We're trying to teach. I know we focus a lot on stocks right now, but we also want to focus on investing in business in general. And that's the whole thing. It's like a good investor understands will do well in all markets. In fact, they'll do better during bad markets. That's what we're trying to do here. A good business will do well when things are bad, because all the businesses that were bad are going to go under and they can take market share. These are always the things to look at. I want everybody to reframe their mindset to more of what we talk about, which is bad times are good for the good investor, for the good business person. You should promote, you should be happy for bad times, because it weeds out your bad competition. It weeds out the fly-by-night guys. That's what you should be hoping for.
Sean, none of the companies today reached all the pillars. Campbells was very close. And
I like Smuckers.
And
Smuckers is probably the one I like the most.
Yeah, and PayPal was close besides the PE ratio, but you can certainly just rewind and see all this. And Paul, tell them about the list in Patreon with the 8 pillars.
So every so often, like maybe once a month, I'm going to publish the list of all the stocks that hit all 8 pillars. Actually, I think I should exclude banks and utilities and insurance companies, which I'll do from now on, because those are way too many, and energy. So Seth, why don't you keep talking while I go do that right now, actually?
You know what's funny, guys? Paul. I also wanted to get your thoughts, guys. If you're just joining, I brought my kids on the show early on to show you what they are and that we're real people here in Akron, Ohio. And Gary said you should start a custodial Roth and 529. I have both for both of my kids, and so my 10-year-old has $3,500 saved. Paul, his goal by his birthday is $5,000. He really wants to be a millionaire by Thursday. What am I saying? By 30. He wants to be a millionaire by 30. But it's kind of sad. You know what's sad, Paul, is I found out that the account that he has saved and me going on my way to start a 529 for him, they hold that against you when you're applying for grant in the future. So God forbid something happens to us. I guess if you save now, the grants for education in the future. My goal is to maybe build up a company like DGF, Paul, to maybe have them get a business degree and maybe take that company over. I'm certain, hopefully, if things work out between you and I.
Because you need to sit there and focus on this at some point, right?
Well, of course. That's what I was just going to say. I would imagine that they might be working for us one day, getting stuff done. Okay, guys, there's lots of questions coming in here. Let's see, there's a deal, Dads with Purpose here. How about this one, Paul? When you decide you need to reallocate things, okay, I'm gonna ask, what do you think about this question?
I don't reallocate. I only buy what I want when I want to do it. I don't believe in changing allocations based on X, Y, or Z. I sit there and say my belief is for everyday savers you pick ETFs that you want to own. You buy them every single month for the rest of the time. I don't believe in reallocation and all that stuff, because I just believe that's timing the market, as opposed to, now people would say, well, Paul, you time the market. Yes, I do, because I can afford to. I have 10 businesses. I have 1,000 units in real estate. I've always said, it doesn't matter to me. If I'm wrong for 5 years, I'm still making money. I'm okay. You guys need to save for retirement. Just stick with the same plan and do it forever.
It's funny. Who just said, Alkali said, yeah, I'd like to be a millionaire on Thursday as well. Wouldn't we all? Paul, you're a millionaire. Tell people what it's like. You've worked so hard, folks. You got to watch this guy on his day-to-day. It's sickening. It's really sickening, the discipline. Now, Paul, you're not married. You don't have children. So, there's obviously your time does not need to be allocated to, putting, effort and love and sometimes pain into those situations. But what is it like to have that financial freedom? I guess, Paul, that's what we're all striving toward, right? Just have enough money to be comfortable, to give to our children. Obviously, you haven't had it for a while, but you're still striving. So maybe talk about that, Paul. You have money, but you're still doing this for the last 2 years for free.
I enjoy this. I just enjoy the teaching I do is all for free at the schools, at the high school and the soon-to-be university in Cleveland. This channel, it's not for free. This channel, I want to make money. It's funny because Amir El Pippi emailed and messaged me on Patreon, and he said, I know that the advertising revenue doesn't matter to you. No, it does matter to me, because I want to make you guys rich. I want to help Seth and Don get rich, and I want to help Trader Mo get richer because he's also rich. I enjoy doing this. I do this because I love doing this. I stepped down from my job as CEO for the reason of focusing on teaching and all this stuff. And this is what I like doing, so I just keep doing it. And you'll be surprised when you start doing the things you actually love doing, you make more money.
Paul, talk about it. You definitely came from money, but your father certainly did not. If for people just joining, tell people about your family's history of getting here and working to what you guys have now.
So I was born in Iraq. My family is all born in Iraq, except for my brother. We came here. I was born in Iraq. 40 days later, we moved to England. We lived there for 3 years and then came to the US. My dad and mom are both doctors. My mom didn't work for several years. My dad's first job as a doctor was in 1984 in Flint, Michigan, making $18,000 per year as a doctor. When we finally moved to Canton in 1990 for my dad to start his practice, my dad had $20,000 saved up, which is still a lot, but it was $20,000 in 1990. And he just did really well with medical practice. And then I happened to be fortunate enough to get into investing and really enjoy it. And it was a match made in heaven because now I just handle the money and keep building on it and building these businesses. And we can buy homes like this. We rent out. I mean, these homes right here make us a ton of money, which is awesome. And Mo's a partner in it. And it's been wonderful.
Yeah, and then folks, like I always say, not that it matters, but I'm coming from obviously, we all have different stories, but I grew up with a mom and dad working. My mom worked for AT&T for 50 years. My dad drove a dump truck. He came home, he came home dirty and tired and sweaty. And so I kind of grew up, I guess, Paul, like your early years, maybe, I kind of grew up with a family that money was a big kind of problem. I was also spoiled. And my mom, God love her, she's 72. She'll be here in an hour to get the kids. And I grew up very spoiled. I had basically whatever I want, and I didn't have to work very hard for it. So somehow
spoiled, not about getting what you want. It's about appreciation. It's a lack of appreciation. You can get everything in the world and not be spoiled. You can get nothing and be spoiled. It's about entitlement and appreciation. If you have those two things, then if you're entitled and you don't appreciate what you have, you're spoiled. I don't care if your parents make $10,000 a year or $10 million a year. I've met awesome down to earth people whose parents make $5 or $10 million a year. I've met spoiled brats whose parents make $30,000 a year. And I'm not just making that up. That is absolutely true. I've seen kids that want to punch in the face going, oh my God, you're an a-hole. And I've met really rich kids that I go, oh my God, you cannot tell they're rich. They're awesome.
And oddly enough, Paul, you have punched someone in the face who was the best man at my wedding.
No, he punched me. He punched me. Yeah. I wasn't. No, he punched me, bro. I didn't punch him. I've never punched anybody in my life.
Well, that's going to change, Paul, because at 10,000 subscribers, you and I are going to wrestle. Now, what do you currently weigh? 186 or something?
180.
Now, I'm at 270, so I don't frankly see how you're going to get me on the ground, let alone flip me over and pin me. So we're going to have to do something. Like I have thought about like tying my strong arm down and blindfolding, but I think if you just grab one of my legs, let's practice when I get to Mexico. We'll film it for the patrons. We'll just practice a little bit.
Oh, you know where we'll practice? There's at the entrance, there's that grassy area.
I know all about Mexico, Paul. We'll practice there. You can practice some wrestling moves. Oh, I see. Yeah. Pulverized says, yeah, you could just kick me right in the junk, and that would probably end the match. That's a great point. So, okay, great. Paul, other people, let's see. So anyway, Paul, I really like, I like reflecting on where we're going. We've had comments, and I know I tend to stick to the hater comments. Everybody does. But, I have comments like, well, Paul, if you're so wealthy, why the hell would you be on YouTube trying to make more money? And, I literally tell the story, guys, is, Paul, it sounds like you have told me that your businesses run so well when you put proper people in the managerial positions that there were times you were very bored at work, right? You're kind of playing chess, and when things are running well, there's not much stress and pressure. You were getting bored. I know this is one of your outlets, so I'm just happy you're sharing it. Guys,
but Seth, this has become a career. Like, I look at this as my job for the future. My job will be everything money and handling all of our investments. That's my job. I don't want the day-to-day in the business anymore. That's all Mikey. I have no desire to. I want to focus purely on everything money and stocks and investing our cash flow into real estate. That's all I want to do because that's what I enjoy. That's all I'm going to do.
Folks, if you weren't here, I have treated these last over 2 years and hundreds of videos. It's really just a learning experience for me. I'm learning with you, and hopefully we can continue this learning process. We have goals. Paul, what is our goal for this channel by this day next year? I guess if we can make it through a pandemic, we can make it through almost anything. So what are your internal goals for this channel and Patreon?
By the way, I also can you pull up Carlos's question at some point? But
sure.
The goal for this is seven-figure subscribers, a lot of people getting a lot of value from what we do, and we provide more benefit for the website. I want the website to be a go-to resource for everyone to manage their money and manage their investments and learn as much as they can about investing. That is my goal. It's awesome. It's fun. We're going to make money doing it, so we're just going to do the right things along the way.
Here's Carlos. Carlos, go ahead, Paul. Do you prefer to be fully invested at all times, rotating the value stocks as others hit full valuation, or sit in cash during periods? Yeah, Paul, I asked you the same things. Remember, I sold everything I owned in January and had full cash, and I asked you the last live stream, did I sort of miss the boat on this huge crash and a buying potential? But going back to Carlos, what do you think?
Well, if it makes you feel better, stocks aren't up that much since January. It's still all-time highs, but you missed the big crash. I got into all cash. Do I regret that? Yes. Will I do that again? Probably not, because I've gotten so much better investing in the last 5 years. I can find value in a lot of areas. I can also do puts and calls. But when stocks of mine that I buy for value hit their values, I sell them. I'm going to sell them and find there are 10,000 stocks out there. When stocks are down a lot more than they are today, there'll be a lot more value opportunities. So my job will be to take the cash from the stocks that hit the values and buy new stocks with that. That is my goal. That's what I'm going to do for myself and my family.
Jonathan is correct. Paul is incredibly wrong. Just buy Tesla, Bitcoins, Amazon, and you'll be rich. How many people have said that this year, John? You're probably right. Tesla is slamming. Bitcoin's off the wall, and you're right. I'd go for it. And I think I've learned. Obviously, we're joking, but I have learned through Paul's discipline teaching is that I don't need to hit it with Bitcoin like all these yahoos that think that's gonna happen. In fact, Paul, I almost did hit it with Bitcoin. I mean, I bought 3 coins at $3,000, got on the hype train, and sold them around $10,000. But actually sold
hype train
on the podcast.
To answer, I do think the S&P 500 is very overvalued. I don't even look at the PE. I just look at the 10-year PE and the price to market, the market to GDP ratio. And I do think the S&P is worth 1,500 to 1,800 on the high side. And people think that's crazy. It's going to fall in half. I do believe it will fall in half at some point. Guys, it came very close. It got to 2190 in 4 weeks in February and March. And we only had like 8,000 people in the country who had COVID. So when people say it's because of COVID, I go, time out. It started to rebound. We only had 8,000 cases in the entire country on March 20th and went to the moon. It's at new highs, and we have 19 million. We have 10 million people who've had it in this country. So I don't want to hear it.
This is a great question, Paul. Travis says, are there any stocks you just keep and never sell?
I said no to that already. I will not. Somebody already asked that. Dave asked. No, that's okay. Dave asked it. I will sell any stock at the right price because I want to always be looking for value. So my job will be sell stocks that are at value and buy stocks that are undervalued. That'll always be my rotation in and out. And I'll just pay the tax and move on.
Well, Paul, what do you think? It's been a long show.
Well, Happy New Year, everybody. Hopefully 2021 is awesome for everybody. That's pretty much it.
Guys, we're incredibly thankful. You've given us a lot of hope and happiness, Paul and I, and we can't thank you. I don't think we thought this could happen one day, Paul, and it's happening. Sometimes I talk to you in the morning, I just look at our subscribers, and it's just like, it's currently happening. That's kind of a weird feeling, right, Paul? Because it hasn't happened for a long time, and now that it's happening, and this is only 8,000 subscribers, Paul. I mean, I can only imagine what these YouTubers, when they have 8 million, really feel like. It's probably
when we have 80,000 subscribers, it's going to be an incredible. Listen, the whole point though is that's why to join the Patreon, because we know the names of everybody who's originally, like we hear from people who were one of our first 400 subscribers, and everybody said it was going to be hard to get to the first 1,000. After that, it would be smooth sailing, and they were right. We had to 1,000 by September 22nd, and it's now December 31st. 3 months and a week later, and we're at 8,700.
Yeah, it's incredible, guys. We'll see you on Patreon. Patreon live streams. We'll be live streaming next Tuesday and Thursday. I see you all there. Happy New Year. Brady, Sean, Dads with Purpose, Bentley, Dom, Tony, Maya, RJ, JP, Peter, Travis, thanks for everything. Husky, Llewellyn, I see you there. And you guys are awesome. Paul, you're awesome. I'll see you in Mexico in just 2 days. See you soon.
Yeah, bro.